Welcome to the MUFG Global Markets FX Week Ahead podcast with Derek Halpenny, Head of Research, Global Markets EMEA and International Securities. It's Friday, March 31st, 2023, and joining Derek to pose some questions on the financial market themes for the week ahead is Simon Mays, Head of UK, Ireland and Swiss Corporate Sales. The following podcast is intended for professional investors and eligible counterparties only, and not for retail clients. Any content should not be regarded as an offer to conduct investment business or an investment recommendation, but for information purposes only.
Afternoon, Derek. It's great to have you here.
Afternoon, Simon. Yeah, good to talk.
And also a welcome to all of our listeners. The last few weeks, it's felt a lot like we've ended the week with increased banking sector concerns. We had Silicon Valley Bank, then Credit Suisse, and then last week, of course, Deutsche Bank. This week feels a lot calmer, and no news out as yet anyway, as we're speaking now. So with no new focuses of concern so far this week, can we assume perhaps that the worst is over now? And if so, what does that mean for the FX markets?
Yeah, definitely. First end of week in a period of calm, or a sense of calm since the 3rd of March, as you've said. So definitely from a markets perspective, we've calmed down. And certainly this week, the brunt of that has been seen in dollar yen. We've had a 30 odd basis point increase in the 2-year Treasury note yield. So the front end has definitely reversed some of the easing that was priced in prior. And as I said, dollar yen is the big mover. The dollar is actually weaker against pretty much every other G10 currency this week. So dollar yen has kind of outperformed quite considerably. And maybe I'll come to that in a minute. But, I think we shouldn't, is it safe to assume we're through the worst? All I would say is that the data indicates, certainly the Fed balance sheet data last week indicates that these support measures have definitely helped, but are still being utilized quite considerably. So, the discount window and the bank term funding program combined, the usage did decline from 164 billion to 153 billion. So hardly a dramatic drop. So there is still that support required, I guess you could say. And then also the foreign and international monetary authorities repo facility, the FEMA repo facility, which jumped to 60 billion last week. That stayed high at 55 billion this week. So again, dollar liquidity needs through the swapping of US Treasuries by some foreign central bank or banks, that's still there as well. And then the loans to the FDIC is the other component, which hasn't changed very much. So all in all, what I would say is the ability to swap at par back to the Fed for liquidity kind of removes the risk of repetition of what happened with SVB. But, there's still strains and stresses. And interestingly, the St. Louis Fed Financial Stress Index, that has obviously jumped. And it's actually jumped to a level we haven't seen since the global financial crisis, if you remove a brief spike during COVID. So yeah, obviously it's very difficult to predict in terms of another event, but all I would say is from a macro perspective, it does look quite likely that we're going to get a slowdown in credit. And from that perspective, there's certainly risks going forward in terms of a slowdown in growth, recession risks increasing, and all of that is certainly partially priced into the markets, but there's still risks of that. So I guess this retracement in terms of yield, I could see it go a bit further, but I'm not convinced it's going to be a sustainable move, because I do think what's happened over the last 3 or 4 weeks is potentially pretty profound. And when we look back, maybe later in the year, we'll still point to this period as being an important turning point in terms of the the tightening cycle and the risks to growth and what happens to growth over the next couple of months. So I think that's really important. And then in particular, dollar yen, in the context of what I've just said, maybe I think it's a bit stretched. It's jumped by nearly 2%, whereas the dollar has weakened against all other G10 currencies. Now, it is fiscal year end, so I do think potentially some end of fiscal year buying of foreign bonds by Japanese investors may be reinforcing that move. Obviously, through the whole year, there's been very, very heavy selling of foreign bonds, record selling of foreign bonds. But that might have meant that certain entities in Japan needed to buy to reweight back towards benchmarks. And that in the 2 weeks of data, the last 2 weeks of data that we have, we've actually had a record buying of foreign bonds over a 2-week period since the data began back in 2001. So that to me is not obviously going to be sustained, and then that support for dollar yen could move away, obviously, and I'd be skeptical of the move higher in dollar yen being sustained going forward. Obviously, also with YCC speculation coming back in with Governor Ueda's first meeting on the 28th of April. So I'd be wary of the move in dollar yen in particular.
Okay, thank you. Yeah. So looking ahead to next week, then I guess with the year-end flows out the way, risk sentiment stabilised a little bit. Is it all eyes back on US data again for catalysts for FX moves?
Yes, I guess, like if we take the assumption that there's no other events on the immediate horizon in terms of banking sector problems, then yeah, we do revert back towards data. And we're at that point where we might start to see, well, certainly the survey data in terms of ISM, we might capture some of what's been happening in terms of hitting sentiment. So maybe there's some downside risks to the ISM data. But certainly, we'll be watching the prices paid for component, for example, in the manufacturing sector. That's bounced for the last 2 months back above the 50 level. Does that continue, or do we see prices paid start to soften again? And then new orders are well below the 50 level, so we've been looking out for that as well. But then obviously it all culminates to the payrolls report on Friday. Consensus there is 240 on non-farm payrolls. All I would say is remember what happened last month. And, the data earlier this month, I guess it's the 31st of March. That came in at 311,000. It was another hefty gain in jobs. But, when you look at the wage data, when you look at the labour supply data, the labour force jumped again. And over the 3 months, there was an increase of 1.7 million in terms of labour supply. And that seems to be depressing wage growth. And the 3-month annualized wage increase was 3.6%, which is actually the weakest average hourly earnings wage growth on a 3-month annualized basis since March 2021. So whatever the print is, obviously, unless it was a huge increase, if the print is more or less in or around that, I think the driver for FX and rates is going to be the wage data in particular. And that is softening. And if there's more evidence of that next Friday, then, I think rates probably stay softer. We had the PC core inflation today. The core services ex housing was softer. So it's all kind of leaning towards the markets getting some endorsement from the drop in rates that we've had of late.
Thank you. And finally, I guess a dig into your trade recommendations. So have you had any changes in your trade views?
Well, based on what I was just saying a minute ago, the trade that we have open and for the last couple of weeks is short dollar yen. Obviously, we've given back some on that this week with the 2% jump in dollar yen. We were deliberating whether to cut it or not, obviously, given we've kind of given back some. But as I said, I just don't think this move to the upside is necessarily going to be sustained. I also didn't mention the other factor is this very big increase in short yen positions reported on IMM from the leveraged fund sector. And what's actually interesting from that component is the build-up in yen shorts has continued in the last couple of weeks when dollar yen has been coming down. That's interesting, and it does suggest that some of these positions are underwater, and obviously there's a negative carry in terms of. Obviously, in terms of the move that we've had, it's obviously a positive carry in terms of the onshore, but that move lower means some of those positions are underwater. And if we don't see the momentum continue to the upside, I think there's a risk that some of those positions could be cut.
Makes sense. Thank you very much for your thoughts, and have a great weekend.
And you. Thanks, Simon.
Thank you for listening to this MUFG Global Markets podcast. Rate, review and subscribe, and reach out to your MUFG sales rep for more information. Come back next week for more insights from the Global Markets Research team.